They say sticks and stones can break your bones, but words can never hurt you. That may be the case, but words can definitely move the markets, which is what we're seeing here today with no real reports coming out. It's just some comments from one of the members of the Federal Reserve Board that is making home loan interest rates really battle with that ceiling of resistance that we talked about yesterday. Today is now November the 17th, 2022. It is 3:20 p.m. and this is the Brent Bruce Daily. Let's take a look and see what words were spoken, how that affected the market, and what we really need to watch out for. Because once again, words are one thing, but actually making a change to the federal funds rate, that's what really matters. So let's take a look and see quickly what we have going on. Okay, so here are the words that came out today. So the Federal Reserve's Bullard, so this is one of the members, James Bullard, and he's also the St. Louis Federal Reserve president, says that rate hikes have had only a limited effect on inflation so far. Okay. Further down here, he mentions that the policy rate is not yet in a zone that may be considered sufficiently restrictive. He wants to see the federal funds rate increased. Down here, he even goes so far as to suggest the proper zone for the federal funds rate would be between 5 and 7%. Okay, guys, remember the federal funds rate right now is at 4, and he's saying he wants it to go to between 5 and 7. I think that we would probably be okay, not as uncomfortable if he had said just 5, but 7 is not anywhere where we want to go on the federal funds rate from the mortgage-backed security perspective. So let's take a look and see what really matters. Okay, so what has that done to the market? Well, just those comments today, we were in a position, I think we were down at one point about 50 or 60. So we had a big drop in the market after that, those wonderful gains that we had been having in the previous few days. Right now, we're down 27 basis points. We're up here on the 10-year Treasury. So let's take just a quick look and see how the technicals are mattering. So here we go. We always talk about technical indicators, and look at how very obviously, I mean, this is not a suggestion. This is obvious that this Fibonacci level is what we are fighting with. So we're banged on it, broke through it, got pulled back down, and now we're fighting with it again. So this is right now what we are fighting with, and we need something that is going to be positive in the respect of bringing inflation down to see this start to break further up after this wonderful run, which really equated to about 7/8%, almost a full percent drop in interest rates, really from about this time period here. We've had such a wonderful run in dropping the interest rates coming down. So now we need to see another reason for moving up. So what is it that is going to be happening in the next few weeks that we can look forward to, and what do we think is going to happen? Okay, so the first thing that we're going to be paying attention to is the personal consumption expenditures. Now, you know, we watch the personal consumption expenditures, the consumer price index, and the move to the federal funds rate. Those are the three things we watch the most. And then some other things like the PPI, wholesale inflation, and things like that we pay attention to as well. So let's see here. When is the next time that we're going to get the personal consumption expenditures price index? Well, it's very easy. Just type it into Google. It'll pull right up. Now, first of all, take a look at June, July, August, and September. Does it look like inflation is going down? Absolutely. Yes, it does. So the Fed member Bullard says, well, he's not really seeing the effects of his increases to the federal funds rate. Well, I am. I'm seeing it right here. It is taking effect. Just slow down and let the effects actually move through the economy. When is the next time the personal consumption expenditures going to be released? Well, look at right here. Current release date was for October 28th. So the October 28th report was for September. Okay, that's right here. And we were coming in with a headline year-over-year number of 6.2. The next release is December 1st. Okay, so December 1st is the next date that you are going to see me get excited. Okay, so December 1st, we're going to get the personal consumption expenditures report, and we need to see that number showing a lower month-over-month reading than the previous year. So we'll get into that as it gets closer. The next thing that we're paying attention to and is going to be coming up soon is the next move for the federal funds rate. So you say, well, when is the next meeting of the Federal Reserve? Well, all you got to do is punch it in. And here is directly from the Board of Governors of the Federal Reserve System. This is their calendar. Let's cruise down here. Let me get me out of the way. So here we go, December 13th and 14th. Okay, so this tells you that they're going to meet on the 13th and they're going to make their announcement on the 14th. So the next announcement to what the Federal Reserve is going to do with the federal funds rate is on the 14th of December. So what do we want to see happen to these numbers? We want the personal consumption expenditure report on the core number, which was at 0.5 last month. We just want it to come in at about a 0.4, 0.3. So we'll look again further into that here in just a little bit. And we want the Federal Reserve to increase the federal funds rate by 0.5% or 0.25%. Now, obviously, you saw Fed member Bullard. I mean, he apparently wants it to go up 0.75 or 1 or something ridiculous like that, not allowing the effects of their moves to penetrate into the economy and instead making our plane nosedive instead of come down in a soft landing. So let's take a look and see where our mortgage-backed securities are right now and where, I'm sorry, not our mortgage-backed securities, but our actual interest rates. Yesterday, we were at, a 6.375 with a little bit of a credit back, right? So let's take a look now. Again, we're down 27 basis points on the day. Not really what we wanted to see. We're stuck at that ceiling of resistance, which is that Fibonacci level. And what do you know? 6.5% is the Brent Bruce Daily 30-year fixed interest rate today with a pretty good credit, $1,400. Let's open this up and see how far it is to get to 6.375. It's going to cost $68. Okay, so once again, the rate that we're really going to offer to our client today for a very well-qualified 30-year fixed conventional home loan is 6.375. Remember, we were talking about 7.125. Every once in a while, touching on a 7.25. I mean, only a couple of weeks ago. So this has been a great run. What if someone says, hey, I want to pay a point? Well, for paying a point, here we go. For less than a point, you're at 5.999. Now, remember, yesterday we were pretty close to this only being a half a point. So you see this on a daily basis, how these numbers really move. Okay, so let's go and make sure that we show our scenario here for compliance purposes. There you go. All right, that is what we have going on. Now, again, make sure that you like, subscribe, and share. And if you have any questions, I'm finally starting to get people from time to time ask questions. So sending an email, responding, or hit me on YouTube and just saying, hey, how does this work? Or what do you think about this? Or what do you think about that? Or even better, hey, can you call my client and see about getting them pre-approved for one of these amazing interest rates? So definitely make sure you reach out. I usually put my link in there with how you can get a hold of me. If there's anything I can help with, please let me know. I will get you more information again tomorrow. Thanks for watching. Have a great day.